If financial markets are efficient, then asset prices should perfectly represent all underlying economic fundamentals. This is known as Farmer's efficient market hypothesis, which over the decades has drawn significant criticism, some more justified than others. There are three versions of the efficient market hypothesis. The weak variation states that past asset prices are fully represented in current asset prices. This implies that past movements in the price of an asset have no predictive power for future performance. The semi-strong form states that all publicly available information should be reflected in an asset price, including its past prices and all known fundamentals. Finally, the strong form states that all relevant information, public or not, is reflected in an asset's price. Empirically, evidence for the weak and semi-strong variation exists fairly convincingly, even if there are some exceptions, but the data does not support the strong form overall, since unannounced information, for instance, can move stock prices when it becomes public. Also be aware that different markets display varying degrees of efficiency. For instance, the highly liquid US stock markets will adjust prices quicker to new information than the less liquid and much more localized real estate market. So generally speaking, while some markets are efficient, not all markets are equally efficient. Now, initially upon its release of the efficient market hypothesis, several studies came out in the years thereafter that collected information in vast support of the theory itself. I will focus mostly on stocks here, since that's what historically has been the focus of the literature, but much of this extends to other asset markets as well. 1. Since efficient markets imply that stock price forecast errors should on average be zero, no successful prediction strategy should be able to survive long, as it wouldn't be rational to ignore it. So if you can come up with some way of outperforming stock markets, others will copy your strategy. Studies of investment advisors or mutual funds that did better in some period of time showed no evidence that they did better later on. And there's many studies of this type. So there really is little evidence to suggest that active trading strategies like stock picking helps creating extra economic profits. And because there is so little evidence of that, what we have seen in recent years and decades is the rise of passive strategies which have lower fees, like for instance Vanguard ETFs that simply track average returns in, for instance, say the S&P 500 or some sub-index of the S&P 500. If you cannot do better than average, there really is no reason to spend money trying. You can simply come up with a passive strategy that tracks the average overall. 2. If information is public, its announcement should not affect asset prices. Rather, that information should already be priced in. The classic example of this are firm earnings announcements. When a firm announces earnings that analysts had more or less expected, whether they're positive or not, stock prices tend to not move the needle at all. Conversely, stock prices tend to move quite a bit if a firm exceeds expectations or underperforms in what is typically referred to as an earnings surprise. Number 3. Empirically, stock prices, especially at higher frequency, that is daily or hourly, behave like so-called random walks. Random walks are statistical time series processes where tomorrow's value is equal to today's values plus minus some, plus what we call a random disturbance. The optimal forecast for such a process at any point in the future is its last known value, because we really don't know which direction it's going to take, and that effectively makes stock prices unpredictable near term. Now, under 2 or 3 quarters, it's basically impossible to predict a stock prices better than with a random walk, and this is typically also read as strong support of at least some form of the efficient market hypothesis. Finally, and this is a story that also is somewhat unpopular, but the evidence is pretty clear here, technical analysis, which relies on observed price patterns in the past to predict future stock price movements tomorrow, do not outperform market returns on average. Doesn't necessarily mean they do worse, but they're also not doing better. Even fundamental analysis, which is much more laborious and adds additional knowledge about stocks from, say, balance sheet information or from firm announcements, does not on average outperform the market in empirical studies. Now, this is the bad news. Now let's come back to some of the arguments that work against the efficient market hypothesis. As time progressed, more evidence emerged that really punched some holes, at least into the stronger forms of the efficient market hypothesis. Much of the early studies here focus on market anomalies, especially in the really very first ones that came out. For instance, in the 60s, 70s, and into the 80s, smaller firms historically had abnormally high returns that persisted over long periods of time. And of course, this is an unexploited or profit opportunity in the meaning of the efficient market hypothesis. That shouldn't be the case. Similarly, stock prices tended to drop off in December and then rally back in January for decades, again generating an unexploited profit opportunity. You should simply buy in December and sell in January. That should make the differential go away. Now, there are some explanations for why these things occur. Could have to do with taxes, could have to do with information or transactions cost. But the patterns are still inconsistent broadly because they create a certain degree of predictability that really shouldn't be there if all information was used. Other events include things, and I'm not going to go into details of all of this, like market overreactions, excess volatility. Mean reversion is a common one. It's a general idea if stock prices have been rising for a while, they have to fall. If they've been sluggish for a while, they have to rise. And similar events. And there's all sorts of evidence that suggests that that's the case. This has been expanded in the recent decade, in the last decade really, in the aftermath of the 2008 financial crisis, where behavioral economics has added certain behaviors that are also inconsistent. One that often comes up is this idea of loss aversion, that people are much more willing to take certain risks on the upside, but they behave really differently when prices are falling. They might sell stock they really shouldn't be selling simply because they're worse of losses. There's more stuff like this. There's a pretty strong literature around this. But what's the overall takeaway? For all practical purposes, things like stock picking or technical analyses do not have much support in the value they add. They're simple, and if you hire someone to deal with your investments, that might provide a certain service for you, but the evidence isn't really there that they're going to do better than, say, some passive fund. At the same time, markets are inefficient enough to create phenomena that shouldn't exist. The most obvious one are asset price bubbles. We'll talk a little bit about that. An asset price bubble is essentially a situation where the price of an asset moves away from its fundamental value. So you're going to buy a house that is really worth, I don't know, $500,000, and you pay $1 million for it instead. Now, that's not efficient in the sense of economics, right? Because you're not paying for value added. There's an income transfer here somewhere. We'll have to talk about why that happens. It's certainly inconsistent with the idea of efficient financial markets. And because these inefficiencies exist, and as we'll see next week, there are two things that really happen in financial markets. For one, we have financial intermediaries that handle most of our financial transactions, and they are precisely there to deal with some of the inefficiencies that exist. And then second, because of these inefficiencies, because there's no first best market solution, we also regulate financial markets and we supervise them. Both of these are really born out of the same insight. Financial markets are efficient enough to outlast your particular liquidity buffer, so I would not gamble and stock pick if I don't have the funds to do it. But they're inefficient enough to work frictionlessly without the help of banks, mutual funds, or regulators themselves.